Chapter 4. Joning the Lemonade Stand. The prime purpose of a business corporation is to pay dividends regularly and, presumably, to increase the rate as time goes on. Benjamin Graham. Johnny is an enterprising young man that would like to start earning some money. He decides that he wants to launch a lemonade business. He needs $200 to build a stand and buy a 1-month supply of lemons and sugar. The problem? His penny bank is empty. To raise the money required for his business, Johnny has two options. He can either borrow the money or sell ownership in his business. Which should he choose? Option 1, he could borrow the cash. Johnny could ask his neighborhood friends Jim and Tim to lend money to his business. Of course, they wouldn't do this for free. If Jim and Tim both gave Johnny $100 each, they would expect that he would pay them back in a few years with some interest. In this scenario, Jim and Tim would buy a bond from Johnny's business. Jim and Tim will get their original money back plus interest as long as Johnny's company stays in business long enough to repay. Option number 2. He could sell ownership in his future business. Johnny could also go to Jim and Tim and offer to sell them an ownership stake in his business. Under this arrangement, Jim and Tim would buy shares of stock in Johnny's business for $100 each. Johnny's lemonade stand wouldn't have to pay this $100 back like it did in the bond scenario. If Jim and Tim owned stock, they would get a part of all future profits. If the company flourishes, Jim and Tim can make a lot of money. If it fails, they will be out their $100. How does the stock make money for you? A stock represents part ownership in a real business. But how does this stock make money for you? And where does that money come from? Let's say Johnny decides to sell stock to fund his new lemonade stand. He divides the ownership stake into 4 pieces and sells one of those pieces each to Jim and one to Tim. Since there are 4 shares, each share is worth 25% of the business. The current ownership structure of Johnny's lemonade stand is Jim owns 1 share, which represents 25%. Tim owns 1 share for 25%. Johnny owns 2 shares, or 50%. There would be thousands, millions, even billions of these shares in a publicly traded company. For example, Apple currently has 5,472,800,000 shares outstanding. If you bought one of those shares, you would own 0.000000001827218% of Apple's business. If you had 617 billion, you could buy all of the shares or the entire company. Let's go back to Johnny and see what happens at his lemonade business over the next few years. Year number 1. In the first year, Johnny uses the investors' $200 to build his lemonade stand and buy lemons and sugar. Johnny sets up shop, makes some delicious lemonade, and ends up selling $200 worth of it. Johnny had $200 in sales, but also $200 in expenses, so year number 1 was a $0 profit. It wasn't a total failure, though. He developed a small customer base that he expects will grow next year. Year number 2. In the second year, Johnny's lemonade business becomes more popular. His sales increase 5 times to $1,000. Expenses also increase to match the growing demand. After paying expenses, Johnny nets a profit of $200. Johnny's business checking account now has $200 in it. He has a decision to make. What should he do with the $200 profit? Johnny has 2 options. He can either 1, reinvest that money back into the business, or 2, pay it out to his shareholders as a dividend. As much as he would like to have the money, Johnny thinks he could earn a higher return on it if he expanded the business. Johnny decides not to pay a dividend in year number 2. Instead, he reinvests the $200 back into the company to build a second lemonade stand across town. Year number 3. In the third year, Johnny's second location doubles his sales to $2,000. Since Johnny is selling more lemonade, he's also buying more supplies. So he strikes a deal with a local grocery store to sell him lemons and sugar in bulk for a 10% discount. This decrease in the cost of his raw materials allows Johnny to earn even more profit per cup. In the third year of operations, Johnny's stand earns $400. Once again, Johnny faces a decision. The business has $400 that he needs to do something with. Should he pay it out to shareholders as a dividend or expand the business even more? If Johnny were to pay the entire amount to shareholders, he would have nothing left to buy more lemons and sugar. So he decides to keep $200 in the business checking account and pay $200 out to shareholders. How stocks make money for you. Number 1, dividends. This brings us to the first way a stock makes money for you, dividend payments. The $200 dividend payment gets paid to each shareholder based on how much of the business they own. Since there are 4 shares, the $200 dividend gets split 4 ways. Johnny's lemonade stand pays out $50 to each share. Jim owns 1 share, so he gets $50. Tim also gets $50 for his share. Johnny owns 2 shares, so he gets $50 times 2 equals 100. Johnny's lemonade stand transfers the appropriate amount to each shareholder's bank account. The dividend works the same way in a publicly traded company, just on a much larger scale. For example, Apple paid out $12.022 billion to their shareholders over the past year. If you own the entire company, you would have received more than $12 billion. But no one person owns all of Apple. That massive $12 billion payout was split amongst the 5.4 billion shares. If you owned 1 share, you would have received $2.16 in the last year. If you owned 10 shares, you would have received $21.60, and 100 shares would bring you $216. The more shares you own, the higher your dividend payout will be. Dividends are the most reliable way that stocks make you money. As long as the business continues to earn positive profits, you will get a part of that paid out to you in cash. The second way stocks make money is through price appreciation. We'll talk about that next. How stocks make money for you. Number 2, price appreciation. Most people don't think much about dividends when it comes to investing in stocks. Getting a $2 payout from Apple each year is boring. Think about it. Have you ever seen a New York Times headline that says, "Apple pays $2.16 in dividends"? No, that's not going to get anyone to read the newspaper. People read newspapers with headlines, "Dow crashes 500 points in single day," or "Double your money in 2 months with these 10 stocks." It is far more exciting to buy Apple at $100 and hope its stock price goes up to $200. Stock price changes are where the real action is on Wall Street, and that's what 99.9% of people talk about. These changes happen every day. Sometimes stocks go up, and sometimes they go down. Over the long run, they will likely go up. But why is that? Why do stocks tend to increase in price over long periods of time? What is the real driver of that value? Let's check back in with Johnny and his lemonade stand to find out. Let's say 10 years have gone by since Jim and Tim made their investment. Johnny's lemonade stand has continued to increase its profits year after year. The business now has lemonade stands in several major cities and 10 unique locations. Johnny partnered with these several restaurants to sell lemonade to customers. In the most recent year, Johnny sold $5,000 worth of lemonade and earned profits of $1,000. Now let's assume that one of the investors decides he would like to sell his shares. Tim approaches Mike from across town. How much do you think Mike will offer to pay Tim for his shares? That depends on several different factors. Number 1, how much could Mike earn on other investment opportunities? Johnny's lemonade stand isn't Mike's only investment opportunity. He could buy real estate, invest in bonds, purchase stock in a different business, or stash money away in his local savings account. To make it simple, let's assume Mike has 2 choices: earn 10% in his checking account or invest in Johnny's lemonade stand. Do you think Mike will be willing to invest in Johnny's lemonade stand if he expected to make 10%? No way. Why? The bank account is a sure bet. Johnny's lemonade stand is far from it. There are a lot of things that could go wrong with Johnny's stand. Competitors could come in with a better recipe and ruin the company's sales. Customers could develop a taste for an alternative product like iced tea. Why would Mike take more risk to earn the same 10% return? He wouldn't. He would either put his money in the bank or pay a lower price for the share of the lemonade stand stock. Now let's assume the bank stops offering 10% and starts offering 1%. Now Johnny's lemonade stand looks a lot more attractive. A 10% return on the stock would be dramatically better than what Mike could get at the bank, so he's willing to pay more. Interest rates influence stock prices because they set the minimum level that investors require on all other risky investments. Higher interest rates make bank deposits, bonds, and other fixed income securities more attractive. Number 2, what is the future growth of the company? Would you prefer to own a company with increasing profits or decreasing profits? Of course, you will want to buy a business that will grow in the future. Mike will be willing to pay more for a share of Johnny's lemonade stand if he believes the profits will grow. Without business growth, companies are worth far less. We will explore this later in the chapter. Number 3, the financial stability of the company. Would you lend money to a friend that had $10,000 in debt and no job? Of course not. Why? You won't get your money back. In the same way, Mike will be less attracted to Johnny's lemonade stand if the company has a lot of debt. So what will Mike pay for his share? Let's follow Mike's thought process as he decides what price to offer Tim for his share. Mike thinks Johnny's stand can continue to make $1,000 per year for the foreseeable future. He also expects the company will continue to pay at least $125 in dividends for each share. Mike can earn 5% in his bank account, so he wants to be sure he can earn at least 5%. Preferably, he would like to make a lot more considering how risky the business could be. Mike decides a 10% return will be acceptable for him. To calculate what he will be willing to pay per share, Mike takes his $125 dividend and divides that by 10%. That gives him a fair price of $1,250 for one share of Johnny's lemonade stand. If he were to make this investment, he would get paid $125 per year. That would be a 10% return on his initial investment of $1,250. Simple enough, right? Now let's throw another wrench into the equation: growth. Dividend growth, the key to value. If Mike expects Johnny's lemonade stand to continue to grow its profits and dividends each year, he will be willing to pay far more for the share than $1,250. Let's assume Mike believes Johnny's lemonade stand will grow its profits by 6% each year. That would result in Mike's $125 dividend payout growing to $132 in year number 2, $140 in year number 3, and so on. To evaluate the shares, Mike will use a simple formula: starting dividend per share divided by price per share equals desired annual return minus expected dividend growth. If we plug everything Mike knows about the lemonade stand, he will come up with a $125 initial dividend divided by price, what he's trying to find, equals 10% minus 6%. After working out the math, Mike would come up with a stock price of $3,125. That is what he should pay for the shares if he wants to get a 10% rate of return. If you aren't completely following the math, don't worry about it. But do grab the concept here. Investors are willing to pay a higher price for a stock with future dividend growth. In this example, Mike paid a hefty premium for the promise of future dividend growth. Without any growth, Mike was only willing to pay $1,250. With 6% growth, Mike was willing to pay $3,125, more than double. Why is dividend growth worth so much? We'll find out in the next chapter.